Well, thank you everyone for joining our webinar today. As always, we have a great webinar in store for you. I want to thank everyone for submitting your questions. That is extremely helpful in helping us shape the content that we're going to cover. Well, a little bit about us. My name is Matt Wilson. I am the president and chief investment officer here at Keen Wealth Advisors. And we host these webinars on a monthly basis, and we like to educate everyone on the issues that they're facing as they're approaching retirement and even transitioning into retirement and then throughout retirement. And you'll see that is the theme of many of our webinars. Today, we're going to cover Social Security and the issues related to Social Security, the things that you should be considering as you're making that decision regarding Social Security as well. And hopefully you have you take away a few pieces of information that help you formulate a decision or at least better understand the choices that you have. We find that Social Security is a very common conversation piece among our clients and even those that aren't clients. It's just a very hot topic. A lot of things going on with Social Security and a lot of different claiming strategies. So today will be a great webinar. Also, just be sure to check out our website if you haven't done so already, keenwealthadvisors.com. Under the Retirement Resources tab, you can find our podcast and replays from our podcast. Also, the video version of our podcast. We're now releasing that on YouTube. Our blog as well that comes out on the weeks that we don't host a podcast, and of course our webinar replays. In addition to that, we also have copies of Mr. Keen's best-selling book, Keen on Retirement Engineering, the Second Half of Your Life. We're on the second edition of that book, and hey, maybe there's a third edition on the horizon because things change, rules change, laws change. And those things, you got to be on top of that, or at least understand how those changes impact you. We've had changes to Social Security over the years. They nothing significant recently, but they do happen from time to time. Yeah, as I mentioned, our YouTube channel, check that out and subscribe to that if you'd like. A lot of great videos on there. We host our podcast. We have the audio version, but also the video version that we've been releasing, and of course our webinar replays are hosted on YouTube. And then lastly, this was a great recognition, kind of a surprise for us. We got a notification that we were recognized by USA Today, by one of the best financial advisory firms in 2025. So happy to accomplish that and share that with everyone. Well, as I mentioned, we're going to cover Social Security and go through different claiming strategies, how the taxes work, just things that you should be aware of if you're facing that decision or as you approach that decision. And we're going to talk through what is the current status of the Social Security trust funds, how much you should expect to receive, the different claiming strategies and how to think about applying for Social Security. Is there a way to maximize your benefits, and how does this fit in the overall context of your financial plan? Because that's a key component to this, because Social Security is a common question is, well, when should I take it? Well, it's not an answer that can be provided in and of itself. We have to put it in the context of your financial plan. If you're married, what does that look like? What are the survivor benefits? Are there difference in ages? Those all play into the decision. Also, what about your other assets? And how does claiming Social Security fit in with your income needs? That's the power of the financial plan, and putting all the pieces together and coming up with a coordinated strategy to ensure that all the pieces are reviewed and discussed, and the strategy is coherent among everything else that you have going on. Well, let's talk about the current state of the trust funds. This is released every single year. It's published on the Social Security's website. Very easy to find, and not surprising. The trust funds are in a state of decline, meaning that there are more outflows than inflows. Not by a significant amount, but it is definitely something that we're paying close attention to. You can see, there's trillions of dollars in these trust funds, but there are a lot of beneficiaries. People have paid into this, and now there are more people claiming it than projected to workforce to pay into it to cover the expenses. And without reform, the current projection, and again, they update this every single year, it does change. If they were to not do anything, and that means Congress or the government, make any rule changes, leave it exactly the way it would be, then the projection would be the inflows from the future workforce would cover 81% of the benefits that are projected to be paid in 2034. So the trust funds, those trillions of dollars, would be exhausted by 2033, and then you would have have a shortfall. Now, does that mean that's going to happen? Unlikely that it would just move into that state, but it's definitely possible, because it does take an act of Congress to do something about it. And this isn't something that is on the immediate concern list of Congress. It's not new. This has been discussed significantly for many years, and the sooner that Congress can address this, the easier the solutions would be. However, Congress just, they're more focused on what's in front of them, and something that is nearly 10 years away is just less of a concern. I believe they will get to it. It's just, again, not on the immediate concern list. And we've been in a state of like this before. There's been, in the early 80s, the trust funds were scheduled to be depleted in roughly 6 months. That's how, before the last significant change to Social Security was made. And what they did at that time was they decided to tax Social Security, and I'll show you how the current tax rules work related to it. But prior to that change, Social Security was completely tax-free. Everyone received it. There was no federal income tax applied to Social Security. There is state income tax in some states. There's very few. For our listeners and viewers that are in Missouri and Kansas, I can tell you that there is no state income tax on Social Security, and that's been a recent change. Prior to last few years, it was definitely taxable in Missouri. Kansas was as well. It was a formula, so may not have been taxed for you depending on your total income and the makeup of that income, but it was definitely part of the calculation. Over the last few years, they have changed the tax rules in both Kansas and Missouri, and now it is tax-free to you all that are receiving Social Security, or those that are planning to stay in those states when you retire. Well, what are some of the solutions? And again, this is part of the trustees report. They do discuss potential solutions. Um, One of the things that they could do is they could increase the wage base, meaning everyone that has earned income. So this is not part of the tax calculation for IRA distributions, pension income, what's considered passive income. You know, if you have kind of rental properties or income from a farm and you're not actively involved in those businesses, then that's considered passive income. It's only earned income. So for our workers on here, that would be W-2 income primarily, and that would be self-employed income if you own your own business. The cap is $176,100 in 2025. So what that means is that as you work, you pay into Social Security as part of the payroll tax, or the FICA tax, as it's technically called, FICA. And there's two pieces to that. There's Social Security and there's Medicare. Social Security is roughly 6.2% of that, and Medicare is like 1.45. Close. May not be those exact percentages, but very, very close to that. And Social Security stops once you hit that earnings threshold, the tax on Social Security. Medicare, it's a much lower percentage, but there is no cap on the income for the Medicare tax. And then the way functionally it works is that you pay half of it as a worker, and your employer pays the other half. That's so you double that, and that gets to to the amount that goes into those trust funds every single year. So one of the things that they could do is either increase the earnings, they can change the tax percentages. Those are two things that are I would say easy to do from from a legislative standpoint, but may not be the most favorable from from the constituent standpoint, meaning, hey, we're either we're increasing our taxes, because really that's just one way to do it, is get more flows coming in via higher taxes. Another solution is to raise the normal retirement age. So currently, the full retirement age for those born in 1960 or later is age 67. And this was part of some of the rule changes that happened in the early 80s. First they instituted the tax, and that created a big windfall when they started doing that. And the way the tax works, again, I'll show you the calculation, but everyone gets a portion of their Social Security tax free, but based on your other income. How much of it is subject to tax is kind of a target, a variable rate based on this calculation. Well, a few years after that, Congress also kind of looked at it and said, well, we should take into consideration that people are living longer. So prior to again, to this tax law, you were eligible at 65, you could claim it at 62, it was tax-free. Well, they instituted tax, and then a few years later, they increased the full retirement age from 65 to 67, and they phased that in over several decades. That didn't just happen overnight, that was phased in. And that's something that I could see Congress also factoring in to some of the solutions. And I would say that is also an easier solution for them. And for two reasons. One, people are living longer. That is, definitely something that has changed since Social Security was instituted. But two, the younger workforce is just probably less concerned about Social Security, so it's not a hot button issue that people are at that age. If you're in your 20s or 30s, you're probably not voting primarily based on Social Security and when you can receive your benefits. I mean, I'm sure some people are, but not. I would say the majority probably aren't thinking about that. Another potential increase is, they could institute another type of tax or surcharge. If your income in retirement is over a certain amount, they may say there's a minimum amount of tax that you have to pay, or a surcharge, as sometimes they call that. They do that currently with Medicare. If you're on Medicare and your income is over certain thresholds, you pay more for your Medicare, and that they could definitely adopt something similar to that. And then lastly, Social Security does increase every year based on inflation, and that is a CPI, Consumer Price Index, that the government tracks, and they publish it. So it's very, very transparent in terms of just, hey, here's how we do it. Here's exactly the inputs, and here's how we've been tracking it over all these years. They could change how that is calculated. There could be a cap. Maybe there's no, once CPI or the inflation number is over a certain percentage, they may say, well, we're not going to pay more than 5%. I'm just making that up. But if it happens to be 6 or 7%, then they may cap that, and that could be a solution. Or they have a different inflation index that they're tracking, and maybe that would be slightly lower. That's also a possibility. So a lot of different solutions. And again, the sooner they address this, the easier it is. But it is something that I would say is everyone's aware of, but not a hot topic for Congress to worry about. And the other thing to know too regarding this is that when they think about solutions, they look for solutions that solve the problem for the next 75 years. They're not looking for indefinite solutions. They're looking for, hey, how do we extend the life of the Social Security trust funds 75 more years, or at least where inflows match outflows? And partly because they don't know what the future population is going to look like. There's just a lot of unknowns related to that. So they don't want to institute something that is either going to be too dramatic, that may not be the correct solution in 100 years from now, but the solution that we need today. Well, let's talk about benefits and how much you can expect to receive. So the way this is calculated is they look at what you've earned, again, to earned income, any income you've paid the payroll tax on, or FICA tax. And then they also factor in the age at which you apply for your benefits. So let's look at how they actually calculate your benefit based on your earned income. So when you get your Social Security statement, or if you log into ssa.gov, which I encourage everyone to at least go through that process, get set up there. They have a new kind of login process, or I say it's new, it's probably been around for a couple of years, this login.gov, where they're kind of trying to coordinate all these different government entities and a kind of a single login place there. But I would encourage everyone, because if there is something that is incorrect and you're not able to log in, then you can at least catch it prior to wanting to apply for Social Security. You can apply for Social Security online, and that is encouraged. Social Security has offices throughout the United States, and you can go to offices, you can schedule appointments, you can call them on the phone. But if you're able to apply online, they do say that is probably the most efficient way to get your Social Security benefit started. But what they do is when you do log in, they look at your highest 35 years of earnings, and you'll see that on there. You'll see those earnings, the earnings history on online or on your statement if you receive it in the mail, and then they index them for inflation. So they know that, well, yeah, what you made 35 years ago is not the dollar amount isn't necessarily relevant to today's dollars, so they try and index it so that it's at least relevant to current dollars. And then they have these bend points, and that's how they calculate it. And I'll show you how those bend points work. It's not overly complicated, but there is a little bit of math involved here. So here's an example. We have someone who is turning 62 in 2025, and they have maxed out their Social Security earnings, meaning they hit the highest earnings threshold that, I said 176,100 is what that earnings threshold is in 2025. And, they've been doing that for many decades. So it was lower in previous years because, again, they inflate that on an annual basis. And then, they inflate your income and come up with this averaged index monthly earnings, or AMIE. So for this person, if they've maxed it out since age 22, their AMIE would be 13,689. Then they take that number and they run it through this formula here in the blue box. And they start with the first, and these numbers do inflate slightly each year, but they start with the first $1,226. They times that by 0.9. Then the next 6,165 times it by 0.32. And then the next portion above that, they times it by 0.5, add that all up. And that is the amount that they would receive at their full retirement age. That's how they calculate it. Probably not something that you could do on your own, but if you have your earnings history, you log in online, you can see the numbers, and then you could calculate it yourself. Going back and trying to inflate all your income would probably be slightly difficult. Now let's talk about the age at which you apply for benefits. So that was the first piece of it, is just, well, how much have you made? That's how they calculate your benefit. And then when you claim Social Security, that is also a factor into how much that you're going to receive. Because what I said in the example was, okay, well, this person, they're 62. That's what their benefit would be at their full retirement age, which would be 67 for that person. So that would be what they would receive. And that's also assuming they continue to work until that age. It would, if they retired and delayed Social Security, that's a possibility. You don't have to claim it just because you retired. You can delay it to all the way up to age 70. You can start at 62, delay it to age 70. And so, yeah, how to think about when you should apply. I mentioned putting it in the context of the financial plan, and that is definitely one of the key steps, because you want to coordinate your withdrawal strategy from your other assets, your other investments, what's the tax plan that you have, and then how does Social Security fit into all of that. But other things that do come into consideration is how healthy you are. What is your life expectancy? I kind of like to say, well, if we knew the date of death, we could back into the exact best time to take Social Security, because we could maximize your lifetime benefit if we knew when you were going to pass away. But since we don't know that, we have to make some educated inputs into those calculations. What is your need for income? Some people, if Social Security is going to be a big portion of your retirement plan and your income plan, so that claiming it could be very important for your plan. If you're planning to work or not, that also factors in. And then, are there survivor benefits available to yourself or your spouse, and potentially even children if they're underage? So full retirement age, as I mentioned, that is something that has been changing over the last several decades. For anyone born 1960 or later, it's age 67. But if your birth year happens to be in 1959 or earlier, you can see what your full retirement age is. And why is that important? Well, it's important because it determines what percentage discount or increase, which I'll show on the next slide, but what percentage discount on this slide you're receiving by claiming it early. So if your full retirement age is age 67, you'll receive 100% of your benefits. That's what they call your primary insurance amount, or PIA. That's 100% of your benefits. If you claim it 66, well, you're going to receive 93.3%. You can see the numbers all the way down to age 62, and then 66, the percentage decrease is less because it is, it's coming off a base of 66 versus a base of 67. And the way these work is it's actually calculated monthly. So if you retire even if you retire at age 60, you're eligible at 62, but you delayed to 67, or even if you delay to 70, every month you wait, you get a slight increase. So you don't have to wait until your birthday, or, hey, I'm 62 now, I have to wait until I'm 63 to receive less of a discount. Every single month you delay it, the calculation increases, or the percentage discount decreases in those months that you delay it. If you do delay it, you can delay it all the way up to age 70. Now, you could delay it beyond that, but you're not going to receive any increases based on delaying it. So for most folks, there really is no reason to delay it past age 70. And you can see here, okay, at 67, you'll receive 100% of your benefit. If your full retirement age is 67, if it's 66, 108%. So it's an 8% annual credit. And again, that's calculated monthly. So if you wait to 66 in 6 months, well, you'll get 6 months worth of that, or call it 4% of the 8% by delaying it 6 months. This is a simple interest as well, so it's not compounded, because you can see here the percentage increases are exactly 8%. So there are benefits to delaying if that makes sense for you and your financial plan. As I mentioned, go to socialsecurity.gov or ssa.gov. You can go to your account there. You can see all these different calculators, get your statement, see your earnings history, a lot of good things on the website there. So let's do some examples with some numbers. So this is based on someone with a primary insurance amount of $3,000. So that's their full retirement benefit at their full retirement age of 67. See here, 67, 100% of their benefit, $3,000. If they were to claim at age 70, they would receive $2,100. And this also looks at on the very far side the impact that the cost of living increase has on your benefit as well. Because let's just say you're 62 today in 2025. You could receive $2,100 today. There's no cost of living increase until next year. That's an annual thing that they factor in. So let's just fast forward, say we're in 2026 now, and you claimed it at 62. Well, you'll get your $2,100 plus whatever the cost of living increase is. In this example, we use 2%. You'd get 2% more of $2,100. But if let's say you delayed it and you're now looking at taking Social Security, well, it'd be $3,000 as your primary insurance amount. 75% of that would be $2,250. However, you also will get the benefit of the 2% COLA that was added to it. So your benefit would actually be $22.95. Now this is assuming we're in now 2026. So that's how, how this COLA factors in, is when we look at future years, you're getting a delayed benefit if you do claim early, but you're also getting the also benefit of those cost of living increases as time goes on. You can also see as you delay it, okay, you get 100%, 108% of your benefit, 116, 124%, plus those cost of living increases, because now we're in the future in this example, and those cost of living increases do add up. Those are very beneficial to to the beneficiaries of Social Security. And even fast forwarding, a little bit more, what we're looking at here is, okay, if you claim it at 67, that's what your future benefit would be at 70 with a 2% cost of living increase. If you run this out to age 100, that's what it would be at age 100 with a 2% increase. If you claimed it early, so you started it at 62 and you received those 2% cost of living increases, that's what the future benefit would be at age 100. And then if you delayed to age 70, you can see what the future benefit would be at age 100 with those cost of living increases. So there's quite a range of payments based on when you decide to begin claiming Social Security. Now let's talk about how the taxes work, because that is a key thing for everyone to understand. A couple of things regarding claiming early is that you do have to be aware of what they call the earnings test. So if you claim Social Security before your full retirement age, so again, let's just assume it's age 67, you claim it at 62, and you're continuing to work and have earned income. So this is not IRA distributions, it's not capital gains, it's not passive income, it's just W-2 self-employment, what they call earned income, and you'll be penalized or taxed $1 in benefits for every $2 over $23,400 in 2025. Now this only applies if you claim it at age 62. Once you hit your full retirement age, so let's say that is age 67, you can still work, you can still have earned income. You don't have to worry about the earnings test anymore. So that is one of the benefits of delaying while you're still working. So if you're still making a very good wage and high wage, you may not make any sense for you to claim Social Security early while you're still working. Now, if you do go part-time, or if you're not earning nearly as much, there's definitely a possibility that could make sense for you. Here's how the taxes work. This is the formula for Social Security tax. So our tax code, while it can seem simplistic at times when you just think of the federal tax brackets, there's income, and there's deductions, and then you have your taxable income, and then your taxable income flows through the brackets. And the more income you have, the higher percentage tax you pay, but it's only on those higher dollars. We have a whole presentation on taxes and retirement and tax planning that we go over that process, and even talk about the Social Security tax as well. Well, Social Security, as I mentioned, it was tax-free early 80s. They said, okay, we got to start taxing this now to make up the shortfall. And they came up with this formula, and this formula has not changed. This has been, these dollar amounts, these thresholds, for a very long time. They're not inflated each year. So these numbers, I've been able to use the same slide for quite some time, because the calculation on Social Security just has not changed. Possible it could change in the future, but it has not changed. So based on your filing status, so if you're married filing jointly, And if your provisional income is under 32,000, well, what's provisional income? Well, down here it's your adjusted gross income plus one half of your Social Security benefit plus any tax exempt interest. So there's some interest that is not subject to federal taxes, and that is interest that is received on municipal bonds. So those are bonds for local municipalities. States issue them for projects and things like that. They're at much lower interest rates because they are tax exempt at the federal level. That only applies to investments that are outside of your retirement account. So if you have money in a 401k or an IRA, well, this tax-free interest doesn't, you receive it, but it's not part of your taxable income because it's in those buckets. When you have money outside of retirement accounts, they don't, the government doesn't necessarily care about pulling distributions out of that. It's just each year you've got to calculate, okay, well, do I have any capital gains? Did I realize any capital gains? Are there dividends and interest that came in? And if some of that interest is tax exempt, then they calculate your taxable income slightly different based on that. But for this calculation, provisional income, they add back in your tax exempt interest. And if that calculation is under 32,000 for a married couple, then Social Security is not taxed. One way to think about this is that if Social Security is your only income, you're probably not paying any tax on it. That's a good rule of thumb. Now, as this provisional income calculation goes up, then the percentage of your Social Security that then is subject to the federal tax increases. So it says up to 50% over here. Well, it's not taxed at 50%. It's just 50% of it, if you're in this threshold, is subject to federal income tax. So you might be in the 22% bracket. 50% of your Social Security is now subject to the 22% bracket. And then once this provisional income gets over 44,000 for this married couple, then 85% of it is subject to whatever federal tax bracket you're in. 15% of it is received tax-free. So everyone gets at least 15% of it tax-free. That's, again, one of the ways to think about it. You can see under these different filing statuses, okay, the calculation is slightly different if you're single. Not quite as high as the married, but not half either. That's a common thing that we see in the tax code, is that sometimes for married couples, they get double the single filer. But in this case, they don't. Sometimes that's called or referred to as the marriage penalty. You're not getting double what a single person would get in this calculation. And then if you're living together and you're thinking, well, what if we just file separately? How would that work? Well, anything over $0 would be subject to the 85% of it counts as income, 15% of it is tax-free. So that's how the tax works. One way to minimize taxes is have more money in a Roth IRA or in the Roth 401k, because distributions from those Roth accounts are not part of this calculation. The other thing would be not having Social Security, meaning delaying it. Because if you're delaying it, it's not going to be subject to that provisional income calculation. Also, just looking at the makeup of your investments and how you pull out money, that will also have an impact on those tax calculations. Again, this is something that we do for all of our clients with our tax calculations each year, looking at, okay, how much of Social Security is subject to tax? How do we minimize that? And what impact does that have? Medicare also is something that you should be aware of. When you're 65, you're eligible for Medicare, and if you're on Medicare at 65, which a lot of folks are, unless you're working and covered by a employer health insurance plan, But let's say you're retired and you're on Medicare, you'll have the Part B premium, which everyone pays, and it could be higher if your income is higher, but the standard baseline premium is $185, and that would be withheld from your Social Security check. And that's what it is in 2025. This Part B premium generally goes up every year. They announce that typically kind of in October, November timeframe, about the same time they announce the cost of living increases. And you'll see what what those Part B premiums are if you're on Medicare and how much will be withheld from your Social Security check. Couple of things to think about. Yeah, when you decide to claim Social Security, if you do claim it early, it's going to be early for the rest of your life. And that's going to have an impact on the surviving spouse and the benefits that they're eligible to receive in those situations. And also, just from a mathematical standpoint, the longer you expect to live, generally the better off you are waiting. Now, again, there's a lot of other factors that go into it, such as your other assets, and are you able to live on those assets prior to starting Social Security, things like that. That all is part of the calculation. There's reasons to take it early too, not to say that everyone should delay. Again, this is a very personal decision. There is not just here's the right answer that you can apply to everyone, because everyone's financial situation is different. And when you take Social Security is definitely one of one of the things that goes into the financial plan. Yeah, if you don't think you're going to live very long, then again, when should you claim it? Well, if you are married, you got to take into consideration the survivor benefit. And here's how the survivor benefit and the spousal benefit work. So the spousal benefit, this if you're married, everyone is eligible for the spousal benefit. And the way it's calculated is it's 1/2 of the primary worker. So primary worker is basically the worker with the highest Social Security benefit. It's half of the primary worker's PIA if the spouse applies at their full retirement age. So, for example, we have John and Jane. John's full benefit is $2,000. Jane's would be $800 on her own earnings record. She worked. Her earnings record says she's eligible for $800. Well, if Jane waits until her full retirement age, she would get at least half of John's. It'd be $1,000. So they give you the higher of the two. Now, if Jane's own benefit was $1,200, well, then she would get $1,200. The spousal benefit would be less, so they wouldn't give you less. That's how that is factored in. The way this is also functionally how it works is that the primary worker must have filed for benefits. So if the spouse is older, let's say the lower income spouse or the lower earning spouse, or maybe they just they didn't have earned income, they worked within the home and just didn't have earned income, they have to wait until the primary worker starts their benefit. They can't claim the spousal benefit until that primary worker has claimed theirs. You are eligible at 62 as the spouse. Again, it's reduced just like it would be for anyone else. But then you don't get an increase for delaying it past your full retirement age as the spouse when claiming the spousal benefit. So if both let's just say this couple, both of them are age 67, and the primary worker is going to delay to age 70, and the lower income worker or the one without a Social Security benefit, If they're not eligible for anything, then the spousal benefit wouldn't be accessible to them until the primary worker decided to turn on their Social Security benefit. So how do you coordinate the spousal benefits? Well, one way to think about it is when the lower earning spouse's primary benefit, PIA, is more than 50% of the higher earning spouse. So meaning the spousal benefit does not factor into this calculation if they expect to live past their early 80s, because that's typically the most common break-even point. Both spouses can delay to age 70, and that typically maximizes their benefit. There's a hybrid strategy where, let's just say, the lower earning spouse's PIA, so they have their own work record, it's just less than the spousal benefit. They can claim it early, and then or even claim it at their full retirement age, and then the higher earning spouse can delay to age 70, and that would get some benefit, some income sooner. Now, if they're claiming, if the lower earning spouse is claiming early and then flipping to the spousal benefit once the primary worker turns theirs on, they're still going to be subject to the early claim discount. So no matter when you claim, it's still that discount applies to you throughout your lifetime. Again, this can be slightly complicated, so we have ways to analyze this and discuss this with everyone individually, and kind of go through what makes sense for you based on, again, if you're married, what are your ages, what are your earnings records, and come up with a strategy that makes sense for you. So let's talk about the survivor benefit and the divorced spouse benefits, because there's also benefits that are available to those that are divorced. Well, here's how the survivor benefit will work. There's kind of two key components to it. So the survivor benefit will depend upon the age at which the deceased spouse originally claimed the benefit. So that is the primary worker. Let's just say they claimed it at 62, so they claimed it early. The survivor benefit will be limited to the higher of the deceased spouse's benefit, or 82.5% of their PIA. So if they claimed it at 62 and their full retirement age was 67, the primary worker, that would be a 70% discount or a 30% discount. They'd receive 70% of their benefit based on those previous slides. Well, Social Security would give them, the surviving spouse, slightly more in that scenario. If the deceased spouse claimed after their full retirement age, the survivor benefit will be what they were receiving. They would get the benefit. The surviving spouse would get the benefit of the deceased spouse delaying their benefit. Because how this works is that the surviving spouse gets the higher of the two. So let's just say we've got John and Jane. John's is $2,000. Jane's is $1,000 for the spousal benefit. John passes away. She would get $2,000. Her $1,000 benefit would stop, but she would get, she'd get his at that point. There's also, so the first factor was, when does the deceased spouse, when did they claim their benefit? And then the second factor is, then when does the surviving spouse claim the benefit? Because the surviving spouse, there's typically, it's common to see a difference in ages. And if the surviving spouse is younger than the deceased spouse, they can claim it. They can claim it as early as age 60, actually, for surviving spouse. But if they claim it before their full retirement age, they'll get a discount. Again, there's always a discount that applies in these scenarios when people claim prior to their full retirement age. They also, though, can delay up until their full retirement age or later, but the survivor benefit will equal 100% of the original benefit should they delay that benefit. Here's an example. We've got Joe and Julie. They're both married, both over full retirement age. Joe is receiving $3,600. Julie is receiving $1,800. Joe passes away. Julie would receive now the $3,600. She would get the survivor benefit, and it would replace her $1,800 benefit. Now, here's kind of how the delayed claiming factors in. Joe's PIA is $3,600. That's, again, his benefit is full retirement age. Joe decides to delay it to age 70. He's going to get 124% of $3,600 or $4,464. Then Joe passes away. Julie's survivor benefit will be the $4,464. Now, if she claims it, if she is younger and had claimed it prior to her full retirement age, she'll get a discount at that time. So that is, again, something that something that needs to be factored in. So some more kind of rules regarding survivor benefits. You had to have been married at least 9 months, except for, in case of an accident. Survivor must be at least 60, because that is the age at which you can claim. Age 50 if you're disabled. Survivor benefit not available if widow or widower remarries before age 60. So something to consider. If you're close to age 60, you had a spouse that passed away, you're thinking about getting remarried, something to factor into that conversation. And then divorced spouse survivor benefits are available, assuming that you were married for at least 10 years. And that actually kind of transitions us to the divorced spouse benefits, because you are eligible for benefits off of your divorced spouse as long as you were married at least 10 years. That is the key threshold there. You have to be unmarried. So if you remarried, so you were divorced, then remarried, well, then that's going to reset that 10-year clock for your eligibility. The ex-spouse has to be at least 62. And if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So your divorced spouse benefit, you don't have to wait until your ex applies for benefits as long as you were divorced more than 2 years ago. So something to be take into consideration. Social Security would know, they would have those figures. They would know what your benefit would be based on your ex-spouse. If those divorced spouse benefits are better than your own, then they'll know what those amounts would be and what discounts would apply if you're claiming it early. You can claim it at full retirement age, things like that. Couple of kind of interesting things is that more than one ex-spouse can receive benefits on the same worker's record. So if you've been married and divorced multiple times and each marriage lasted more than 10 years, well, you can have multiple ex-spouses claiming benefits. And the ex-spouse benefits that are being paid do not impact the other ex-spouse, do not impact if there's a remarriage, the current spouse, other ex-spouses, they're all just in their own calculation, does not impact anyone. And then if divorced spouse benefits do stop upon remarriage, so that is something to take into consideration if you are thinking about getting married and on Social Security. Well, again, we covered a lot. This is a topic that is very nuanced. It can feel sort of simple, but then you have all these other kind of key considerations, such as surviving spouse. How long do you think you're going to live? What are your other assets? What's your tax plan? Because that is all part of the calculation and the things that we consider when advising people on Social Security strategy. And you know, one of the keys though to remember, always remember, is that you can decide to delay it. Like you could be retired, you're eligible at 62, you're living off your investments, and you might feel like, well, I'd rather start getting Social Security than taking as much money out of my investments. You know, definitely a good thought to have. Um, but then we factor in, okay, well, what taxes are you going to pay? How long do we really think you're going to live? Again, no one knows what that answer is, but let's just kind of run some different scenarios. Are you married? What's the health of your spouse? What's the life expectancy of them? And well, that all kind of keys into that decision. And then if the decision is, okay, well, we're gonna delay. We're eligible at 62, we're retired, but we're gonna delay to age 70. You don't need to do anything. You don't need to tell Social Security Administration. You just don't apply for it. And you can change your mind at any time. Every month you wait, you get an increase. You get the benefit of waiting. So it's not like you make this decision and then you're locked in. It's just once you're eligible, you can always turn it on. That's always an option. So just something to consider, take into consideration when thinking about Social Security, when to claim it, and how to maximize your benefit. And you know, as I've been saying kind of throughout the webinar today, it's like in the context of your financial plan, because what other income do you have? How much do you have in retirement accounts, traditional IRAs, 401ks, Roth IRAs, the Roth 401k? We know that you're going to have required minimum distributions in the future, and are Roth conversions part of the strategy prior to your required minimum distributions at age 73? That all that all is part of the calculation and things that we consider when again when advising people on Social Security. Well, we can help you think through all this. Of course, you know, there's many clients on today's webinar, and this is a very common conversation that we're having for people as they're approaching that decision, and even in the midst of the decision. You know, again, if someone decides to delay as part of our recommendation to them, we talk about it all the time until they start claiming Social Security. And then, you know, that's typically behind you at that point. You don't have to think about it anymore, but it is a thing that is part of the conversation on a routine basis when, you know, when we're thinking about Social Security and when to turn it on. And also, if you're already on Social Security, well, we'll talk through what are the options you have. You know, how does this look? What are the survivor benefits? You know, the potential survivor benefits. Run through those scenarios for you as well. Again, thank you all for joining. I appreciate all of the questions that were submitted. You know, I tried to address as many as I could throughout today's webinar, but also we will take those questions, address them in a future podcast episode. So be on the lookout for that here in the next few weeks, and we'll have another webinar here in September, and you know, throughout the rest of the year. So again, hope everyone is having a great day, enjoying the nice weather we're having here in the Midwest, and we will see you next month.